What's up everyone, Dylan here. I wanted to hop on and do another episode of the weekly analysis video. I took a brief pause on these due to the holidays, but going into the new year, I plan on posting them way more consistently. I appreciate any feedback or recommendations anyone has, as they go a long way to, giving me an idea of how to cater to everyone's wants and needs. So as always, in this video, I'm going to be talking about what's been going on in the market, some micro and macro insights, and then I'm going to be going over some hypothetical scenarios that I believe could happen in the near term, and with those, what I will be looking at. So with that said, we'll hop right into it. So the market managed to rally a significant amount from the end of October to the days leading up to the new year. In fact, the S&P 500 had 9 consecutive green weeks, which was the longest winning streak in 20 years. The main factor behind that rally was the assumption that the Fed was done with rate hikes and would be cutting rates early and aggressively in 2024. Okay? So, if that assumption is proven to be wrong, the market is vulnerable to a larger pullback, okay? And the reason I bring this up is because this Thursday and this Friday, we have inflation data coming out. So Thursday we have CPI and Friday we have PPI. You're going to want to, glance or, really take a look at the data that comes out, because if we start to see an uptick in inflation, like I said, the market will be more vulnerable to sudden drops and larger corrections. Okay, so ideally for bulls, they want to see inflation data continue in a downward trend. Okay, and that will give the bulls the highest probability of price moving back to the upside. Okay, so in terms of what we've been seeing so far this year, right, in the new year, we've been seeing a downtrend, okay? Now, if we look at a larger picture, which a lot of retail traders fail to do, right, this recent pullback is very, very small relative to this large move over the last 2 months, okay? So it's very important to look at the larger picture, okay? On top of the fact that this is a small, pullback relative to what we saw in November and December, a lot of what we've been seeing is due to the timing aspect. And what I mean by that is there's something called rebalancing, okay? Funds will tend to take profit in the sectors that outperformed last year because they qualify for better capital gains tax if they, sell it after a full year's holding time. Okay, so essentially, any funds that had tech in their portfolios at the start of 2023 can now sell those tech names, and capitalize on such a large rally from the year of 2023. And what they'll do is they'll rebalance and kind of rotate those profits into sectors that were underperforming in the previous year. And I'll show you just that. So to kind of give you some data to support what I'm saying, we're going to be looking at the sector tractor from sectorspiders.com. So you could clearly see so far in the last week, right, in terms of when the new year started, we could see that XLK, which is technology, and XLY, which is consumer discretionary. In other words, it's mainly travel names such as Wynn Resorts, Las Vegas Sands, you have MGM, you have Airbnb, right? Those two sectors are clearly the biggest underperformers so far in the new year, okay? what's interesting, and like I said, this is what proves my point to be correct, is that those two sectors were in the top 3 outperformers in 2023. So I'm going to go to a 1-year timeline, and you'll see XLY and XLK were, like I said, within the top 3 performing sectors in 2023. So all we're seeing over the last week is just a rebalance, right? Folks are taking profit in the strong sectors from 2023, and they're taking those profits and putting them into sectors that underperformed with the hope that those will kind of catch up this year. Okay, so not only do we see the underperformance or the outperforming ones start to underperform, but we also see the inverse as well, right? So you could see healthcare is outperforming so far this year, as well as utilities. So XLU and XLV, right? We go over here, you could see XLV clearly relative to technology was underperforming, right? Same with utilities. Utilities was the biggest underperformer last year, and now it's leading the way, right? Now it's nearly leading the way, minus the healthcare. So clearly that is what we've been seeing so far this year. Now, Dylan, what does that mean? Okay, what it tends to mean is that the rebalance period is short-lived. Okay, so essentially what tends to happen is that downside pressure that we've been seeing will be short-lived, because in terms of the macro environment, not much has changed. Now, that doesn't mean that it's impossible to see a script change in the macro environment. As I said, Thursday and Friday we have CPI and PPI. If we do see, a decent size uptick in inflation, then we'll see a larger macro flip, and as a result, like I said, that can cause a larger drawdown in the overall market. But for now, what we've been seeing for now, despite the market coming off in the first week of the new year, it tends to be short-lived. Okay, so bear with me one sec. So I'm going to go over some technical areas, okay? So clearly, over the last week, the bears have been in control, okay? And one way to really show that is by showing you guys this pattern, okay? So you'll see that previous intraday lows have become resistance, okay? So support has become resistance. So you can see that was a intraday low on December 28th. Price then broke below that low, and then on the retest, bears defended it, okay? Same deal. The low from December 29th, right? Price after that retest broke below, and then yet again, bears defended that exact low. Okay, going forward, same deal, right? We've been seeing the same script where bears have been showing that they have been in control. Okay, the first time that it did not happen was on Friday. You could see on Friday, using Thursday's low, the bulls managed to break above and recapture that area. Okay, so so far, 4 out of the 5 days were, had full control of the bears up until this past Friday, where the bulls started to show some signs of life. Despite the bulls being able to recapture previous day low, they are not out of the woodshed just yet. Okay, so what we've been seeing this is another bearish sign. We've been seeing lower highs take place. Okay, so you can see here, each subsequent day has resulted in a lower high. Okay, including, right, this one, right? Let's copy that one, right? So each subsequent day has been a lower high. Okay, so despite Friday's ability to rally higher and recapture previous day low, it still was unable to break above the previous day high. Okay, so going into the near term, what the bulls want to see is for the ability for price to break above a previous day high. Not only does it need to break above that previous day high, but they also want to see price be able to sustain value. That's very, very important. Okay, so what could happen is this, right? Price breaks above and then ends up being a trap, right? That's not what the bulls want to see. Instead, the bulls want to see price break above that previous high and then get supported there for, if they see that, price is being supported there and kind of basing there, then that could result in a further move to the upside. Okay, so you want to see price not only break above previous day high, but also sustain value above. So that's definitely something to look at going into the near term. Okay, so on Friday, the bulls managed to bounce in a very, very important area where I actually expected for price to bounce in plain English. Right, we had this demand zone from that was established in December. Okay, on top of that, we had it come down to this 4,700 psychological whole number as well. So just to show you some transparency, I took a long at 47.09 on Friday because, like I said, I expected price to bounce there, and that's exactly what it did. So that is a good sign. The fact that bulls defended right where they kind of needed to, and B, they were able to recapture previous day's lows. Okay, like I said, they're not out of the woodshed because they have been unable to break above previous day's highs, but that's the next step that we look at. Okay, it hasn't been able to happen yet, but it could happen tonight, it could happen tomorrow, it could happen Tuesday. Who knows? So going forward, that's what we want to look for. Now, let's talk about some other things. I'm going to just make a blank slate. Okay, so if price, like I said, if price starts to sustain value above a previous day's high and kind of make its way to the upside, you want to look at the 50% retracement from the recent highs to the recent lows. So rule of thumb is that bears technically, if bears have a few consecutive days of complete control, as I just showed you how they were defending previous day's lows, they will probably try to defend that 50% area at 4771. So if you're a bull, you want it to break above that and sustain value above there, okay? So that's kind of like a rule of thumb in order to, kind of figure out an area to gauge, okay? So if the bulls are unable to sustain value and you see price start to come off, let's just say it happens on Thursday or Friday with CPI and PPI, you see an uptick in inflation, which will, kind of portray that the Fed will have their rates higher for longer, right? That would be perceived as bearish. And as a result, the market will probably, sell off pretty hard on that information. Okay. So to the downside, I wanted to give you some areas to look at. So if this general area breaches, okay, this 4710 to 4700 area, these are some of the areas that I will be looking at to the downside. Okay, so we're going to go to a daily chart. Okay, I want to highlight this area right here on the S&P 500. So this area right here was significant because it was a previous area of consolidation, right? Not only was it consolidation for a couple weeks straight, but it kind of also, triggered a nice uptrend from that consolidation area. So usually when price gets back into a previous area of consolidation that broke out to a nice trending, rally to the upside, price tends to want to bounce there. It's not guaranteed, but it's definitely worth looking at. Okay? And what's interesting about this general area, let's call it in the middle, right? Let's use a fib to get kind of in the middle of that zone that I'm talking about. It would be 46.27-ish, right? Nothing's perfect, but I'm going to draw a line at 47, call it 46.28, right? We'll make it pink so it can show. Okay, so what's interesting about that general area is the fact that it is, call it 2.4% away from where the S&P is currently trading. That lines up with a key area on NASDAQ, okay? So the NASDAQ has the 50-day moving average, okay? And to preface, I personally do not like looking at moving averages when it comes to an intraday basis. I just don't like it, right? I think it's overwhelming. It's too much noise. However, when it comes to larger time frames such as the daily chart, right? A lot of algorithms will have buy programs and sell programs tied to these big moving averages, such as the 200-day, 50-day, 100-day, right? So on a larger time frame visual, I will look at them, okay? So I just want to kind of set that straight. So you could see, like I said, the S&P is what? The S&P, what did I say, 2.4%? 2.4% from like the 50% retracement of that that consolidation zone. The NASDAQ from the 50-day moving average is, call it 2.10%. So there is a possibility that those two indices will hit those areas at the same time, which would be ideal. If you're a bull and you're looking at that area to act as support, you want to see the S&P and the NASDAQ get down to an area of support at the same time. The more instruments that are at support at the same time, the more likely it will work, okay, in plain English. Also, another thing that lines up with that 50-day is the anchored VWAP, okay? So if we take the anchored VWAP from the October lows, you can see that it comes pretty close to lining up with the 50-day. So that general area, like I said, is around, say, 2.4%. So assuming that the S&P and the NASDAQ, move in unison and they both go down at the same, caliber, they could potentially test that general area at the same time. And if they do, I will definitely be looking at that area for a potential long. Okay, so that is what I'm looking at to the downside. In terms of, the very, very short term, like I said, I highlighted this area on the S&P, this 4,700 area, right, where price bounced on Friday, right, and this demand zone, right. This could definitely continue to the upside, because another thing that's interesting is the fact that Apple has the 200-day moving average right where it's at. So 200-day moving average is like the mother of moving averages. It's like, it's like it's the big one. So the fact that it was able to bounce right near that 180 level, right, which was the 200-day moving average, despite three pieces of bearish information. So you can see in the last week, the Apple's down 6.5%, whereas the S&P is only down 1.9%. So Apple has been showing relative weakness relative to the S&P 500. Okay, Apple has had two sell-side downgrades from Barclays and Piper, and they had a lawsuit threat from the DOJ. So three pieces of bearish catalysts, yet buyers managed to defend that 200-day moving average. So the fact that they're able to kind of absorb that downside pressure is definitely a good thing in the near term. And as a result, if that continues to be the case, then the S&P and the NASDAQ should have, a good ability to kind of move to the upside. So that's about it for me. If you guys like this video, give it a thumbs up. Like I said, any feedback is so appreciated. So please, even if it's something small, please put it in the comment section. But like I said, you can expect me to post these on a weekly basis for the most part. And that's about it. Peace.